Digital money. Bits and bytes, not bills and coins. The way we pay for things is changing. Cash is becoming less common. In its place, we see a rise in digital money. This digital money isn't physical. It exists as information on computers and phones. It's like the numbers you see in your bank account, but it can be used in more ways. Digital money encompasses two main types: the money we use in our bank accounts and cryptocurrencies. We're all familiar with bank money. It's the digital representation of the traditional money we've used for centuries. We check our balances online, make transfers, and pay with cards, all digitally. This digital form makes transactions faster and more efficient. Cryptocurrencies, on the other hand, are a newer form of digital money. They operate on blockchain technology, a decentralized and secure way to track transactions. Bitcoin, the first and most famous cryptocurrency, emerged in 2009. It offered a way to exchange value without the need for banks or governments. The rise of digital money, both in its traditional and crypto forms, signifies a shift in how we think about and use money. It's a move towards a more digitized, globalized financial system. But as with any major shift, this change comes with both potential benefits and risks. Bank money versus crypto, two sides of the same digital coin. While both bank money and cryptocurrencies exist in the digital realm, they operate under very different principles. Bank money is centralized, controlled by governments and financial institutions. When you make a transaction, your bank verifies and records it. This centralized system provides a level of security and trust, but it also means your money is subject to the rules and regulations of your country. Cryptocurrencies, in contrast, are decentralized. They operate on a distributed ledger system, meaning transactions are recorded and verified by a network of computers rather than a central authority. This decentralized nature makes cryptocurrencies resistant to censorship and control by any single entity. Another key difference lies in their underlying technology. Bank money relies on traditional financial infrastructure, with accounts and transactions managed by banks and payment processors. Cryptocurrencies, on the other hand, leverage blockchain technology. This secure and transparent system allows for peer-to-peer transactions without intermediaries. The choice between bank money and cryptocurrencies often comes down to individual needs and values. Those seeking security and familiarity may prefer bank money. Those who value privacy, autonomy, and the potential for innovation might gravitate towards cryptocurrencies. Following the digital trail, transparency and control. One of the key characteristics of digital money is its traceability. Every transaction leaves a digital footprint, a record that can be tracked and analyzed. This transparency has both positive and negative implications. On the one hand, it can help deter fraud and money laundering. Law enforcement agencies can follow the flow of digital money to investigate criminal activity. For governments, the digital trail offers a new level of control over financial transactions. They can monitor economic activity, track tax payments, and implement targeted sanctions with greater precision. This ability to track and analyze financial flows can be a powerful tool for governments, but it also raises concerns about privacy and surveillance. The rise of digital money has led to discussions about central bank digital currencies, cbdc's. These are digital versions of a country's fiat currency, issued and regulated by the central bank. cbdc's could offer greater efficiency and security in financial transactions, but they also raise concerns about government overreach and the potential for financial exclusion. As digital money becomes more prevalent, the balance between transparency and privacy will be a key issue for policymakers, financial institutions, and individuals alike. Finding ways to harness the benefits of traceability while protecting individual freedoms will be crucial for the future of digital finance. The digital ruble and the EUN governments enter the ring. Governments around the world are taking notice of the digital money revolution. Many are exploring the potential of central bank digital currencies, cbdc's. China has been at the forefront of this movement, actively developing and testing its digital yuan, also known as the ECNY. The digital yuan aims to provide a more efficient and secure payment system, reduce reliance on cash, and enhance the government's control over financial flows. Russia, too, has been developing its own cbdc, the digital ruble. Faced with international sanctions following its invasion of Ukraine, Russia sees the digital ruble as a way to circumvent financial restrictions and strengthen its domestic financial system. The digital ruble could facilitate cross-border transactions with countries that are willing to bypass the SWIFT system, a global financial messaging system that has been used to impose sanctions on Russia. The introduction of CBDCs by major economies like China and Russia could have significant implications for the global financial landscape. It could challenge the dominance of the US dollar and lead to a more multipolar world where different currencies and payment systems compete. The development and adoption of CBDCs are still in their early stages. However, they represent a significant step towards a more digitized and potentially fragmented global financial system. How these digital currencies will interact with existing financial infrastructure and what impact they will have on international trade and monetary policy remains to be seen. For centuries, banks have been the gatekeepers of our financial system. They hold our money, facilitate transactions, and provide a range of financial services. But the emergence of digital money and innovative technologies is challenging the traditional role of banks. Cryptocurrencies, with their decentralized nature, offer an alternative to traditional banking. They allow for peer-to-peer transactions, bypassing the need for intermediaries like banks. This potential for disintermediation has led some to question the continued relevance of banks in a digital world. Decentralized finance, or DeFi platforms, are taking this concept further. Built on blockchain technology, DeFi platforms offer a range of financial services, such as lending, borrowing, and trading, without relying on traditional financial institutions. These platforms operate autonomously, governed by smart contracts rather than human intervention. While the idea of a world without banks might seem radical, the financial landscape is evolving rapidly. Digital money and decentralized technologies are creating new possibilities for how we manage and interact with our finances. The role of banks is likely to transform, perhaps becoming more specialized or integrated with these emerging technologies. As our financial lives become increasingly digital, data security and privacy become paramount concerns. Digital money systems, by their very nature, rely on the collection and storage of vast amounts of personal information. This data can be a target for hackers and cybercriminals who seek to exploit vulnerabilities for financial gain. Breaches of financial data can have devastating consequences, leading to identity theft, financial loss, and erosion of trust in digital systems. Protecting digital money systems requires robust cybersecurity measures, including encryption, multi-factor authentication, and constant vigilance against emerging threats. Privacy is another key concern in the realm of digital finance. The ability to track and analyze digital transactions raises concerns about government surveillance and the potential for misuse of personal information. Striking a balance between security and privacy will be a crucial challenge for policymakers, financial institutions, and technology companies. Developing clear regulations around data privacy, promoting transparency in data collection practices, and empowering individuals with control over their data will be essential for building a trustworthy and secure digital financial system. The world of money is undergoing a profound transformation. Digital money in its various forms is reshaping how we transact, invest, and interact with the financial system. The future of money is likely to be a tapestry woven from both traditional and digital threads. Central bank digital currencies are poised to play a significant role, offering greater efficiency and control over monetary policy. Cryptocurrencies, with their decentralized and innovative nature, will continue to challenge traditional financial models and offer alternative ways to manage and exchange value. Decentralized finance platforms hold the potential to democratize access to financial services, empower individuals, and foster greater transparency in the financial system. However, challenges remain in terms of scalability, security, privacy, and regulatory clarity. The future of money will be shaped by technological advancements, regulatory frameworks, and evolving user preferences. Navigating this rapidly changing landscape requires adaptability, innovation, and a focus on building a financial system that is secure, inclusive, and sustainable for all.